Yo, good morning, guys. All right, so we're getting into Gary's new hearing here. Gary and the head of the CFTC as well are they're asking for money, guys, for their budgets for next year, so that Gary can go after and attack crypto again, even more next year. So this is his reasoning behind it, what his plan is. They will be testifying. So let's check this out, guys. Just so you guys know, I don't know how long this is. Could be a couple of hours. Could be only an hour. I'm heading out. So I will be back to stop the stream. If it's done by the time I get back, I'll be gone for about a half hour. Anyway, guys, enjoy this. Enjoy this feed. Watch Gary begging for money so that he can attack crypto.
This hearing of the FISG Subcommittee, the Appropriations Committee, will come to order. Welcome, everyone. My partner in this committee, Senator Hagerty, and I have agreed to forego opening statements in the interests of allowing more time for questioning. So I will introduce both of our witnesses, and if you could make sure you provide your testimony within 5 minutes, your full statements will be provided for the record. We'll proceed from there and then have 7 minutes of questioning by members and 1 or 2 rounds. So let me introduce our witnesses here. We have the chairman of the Securities and Exchange Commission, Gary Gensler, who was sworn in as chairman in April 2021. Before joining the SEC, Mr. Gensler has had a variety of positions in and out of government. He was formerly the chair of the U.S. Commodities Future Trading Commission, the CFTC. He also served as Undersecretary of the Treasury for Domestic Finance and as Assistant Secretary of the Treasury from 1997 to 2008. in one. He also did a stint at MIT teaching cryptocurrency and other related matters. Prior to his public service, Chairman Gensler worked at Goldman Sachs as a partner in the Mergers and Acquisition Department. He received his undergraduate degree in economics and his MBA from the Wharton School at the University of Pennsylvania. Welcome, Chairman Gensler. Chairman Russ Benham was sworn in as chairman of the CFTC in January 2002. His arrival at the CFTC follows extensive experience in financial and agricultural markets. Before joining the CFTC, Chairman Benham served as senior counsel to our colleague, Senator Debbie Stabenow of Michigan, who's the chair of the U.S. Senate Committee on Agriculture, Nutrition, and Forestry. During his time in the Senate, Chairman Benham advised on and helped implement the Dodd-Frank Wall Street Reform and Consumer Protection Act. Chairman Benham is a graduate of Georgetown University and Syracuse University's School of Law. Colleagues, I'm proud to say both of these gentlemen live in the great city of Baltimore. With that, let me turn it over first to you, Chairman Gensler.
Thank you. Good morning, Chair Van Hollen, Ranking Member Haggerty, Senator Kennedy. Thank you for inviting me to testify today on the SEC's fiscal year 2025 budget request. As is customary, I'd like to note that my views are my own as the chair of the SEC. I'm not speaking on behalf of my fellow commissioners or SEC staff. I also want to thank you. I think I was with you last year at this time, but also I was with you 12 years ago, and I was in Chair Benham's seat because I was with Chair Mary Shapiro. So I've done one of these partner hearings once before. Last week at the SEC, we had our 90th birthday. Congress and President Roosevelt set our agency up June 6, 1934, in the aftermath of the Great Depression to ensure that our capital markets work for investors and issuers alike. They knew this was critical to restoring trust in the markets and promoting the economy. The SEC they created serves investors building for a better future and issuers raising money to fund innovation while overseeing the capital markets in the middle. But it's really about the issuers and the investors. The SEC is a cop on the beat, watching out for the investing public and those issuers. I believe the securities laws and the agency set up by Roosevelt and Congress have been a significant contributor to our economic success in those 90 years. I also think it's a key agency in terms of our standing around the globe. Our $110 trillion capital market is 40% of the world's capital market, even though our economy is only about 23% of the world's capital market. So we punch above our weight class. And I think this gives us certain advantages as a nation and for investors and issuers. But I don't think we can take the leadership for granted. Today, our limited resources contrast against tremendous growth and change in our markets. In the face of the significant growth in registrants, complexity, individual investor engagement in the markets that are outlined in the written testimony, I think that you might think that we had grown. But in fact, the SEC actually shrank between 2016 and 2022. With Congress's help, we were authorized to hire 400 people in 2023 on about a base of 4,600. So to get back to approximately 5,000, to bring us back just modestly above 2016. While our funding was kept flat in 24, growth in the market activity was anything but flat. We are losing pace with an ever-increasing scale of the capital markets. Transaction volume, just to name one thing, in the equities market doubled in the last 5 years, tripled in the last 17 years. Today, we have 15,000 plus registered investment advisors advising 57 million clients. Just 6 years or 7 years ago, it was 12,000 and only 43 million. So you can see all this growth in the markets. I'd note also that the $32 trillion mutual fund business, registered funds, the $30 trillion private funds, each in and of themselves are bigger than our entire banking system, which is only $23 trillion. Such growth and rapid change also means more possibility for wrongdoing. We've seen the number of tips, complaints, and referrals we get climb from 16,700 just 5 years ago to 40,000 last year. Allow me to put flat funding into context. 70% of our budget is for staff, 15% for technology, about 5% for facilities, 10% for everything else. So staffs is the bulk of it. Flat funding means cutting staffing, technology, and real estate. It's pretty straight math. We have paused on nearly all job postings and backfilling departing staff since last September. We currently have about 325 positions that were authorized that we are not filling. While the agency's rule set gets outsized attention, and I'm sure we'll talk about some of that rulemaking, the vast majority of our staff work on oversight of the markets, responding to inquiries, and collectively we get tens of thousands of those a year. And without additional resources, I think the markets and our oversight are at risk. Our ability to find bad actors are at risk. Our responsiveness to market participants is at risk. I think capital formation and innovation are at risk. So as this committee continues to work, I note our funding is also deficit neutral because we have these Section 31 fees that we charge. So that's a good thing. Sorry, Russ. But we do have that baked in. I'm glad to take your questions, and thank you.
Thank you, Chairman Gensler. Chairman Benham.
Thank you, Chairman Van Hollen, Ranking Member Haggerty, Senator Kennedy. Great to be with you today. Appreciate the opportunity to testify before you today on the President's fiscal year 2025 budget for the Commodity Futures Trading Commission. And as with Chair Gensler, these views are my own. For over a century, derivatives markets have played a key role in the U.S. economy, promoting economic growth and contributing to financial stability and the predictability of prices that impact all Americans. This October, the CFTC will commemorate its 50th anniversary. And this milestone provides a natural inflection point as we consider how the past 50 years will impact the next. I've witnessed the massive expansion of the CFTC's jurisdiction through Title VII of the Dodd-Frank Act, also organic growth in our historic markets, the introduction of new products, including the digital commodity asset class, and the significant expansion of market participants, both institutional and retail. Given this exponential global growth, I have prioritized a collaborative working relationship with our domestic and international regulatory partners to ensure regulatory harmonization, market efficiency, and reducing unintended and negative consequences to U.S. derivatives markets. For fiscal year 2025, the Commission is requesting a total of $399,725 FTE. The request for its operational budget was developed with the Fiscal Responsibility Act of 2023 in mind. We have sought to focus on the most critical areas to reach this number that represents about a 2.9% decrease below the FY24 budget request and just over a 9% increase above the FY23 and 24 enacted budget. As chair, I have focused on identifying and addressing regulatory gaps and uncertainty, strengthening the agency organizationally so that we are an operationally effective, diverse, and competitively attractive employer, better understanding and incorporating the digital asset ecosystem, artificial intelligence, and cybersecurity into our decision-making, and addressing the needs for guidance regarding emerging product and market structures, such as voluntary carbon credit, derivative contracts, and vertical integration. To date, and thanks to my fellow commissioners and the incredibly hardworking staff of the CFTC, the agency has stayed on course following an agenda I outlined in early 2023. I described the action items by themes, including risk management and resilience, customer protections, efficiency and innovation, reporting and data policy, duplicative regulatory requirements, and international comity. Fundamental to all of these topics is the need to update our rule set to address the derivatives industry's current course, which is driven by technology and seeks to both leverage and, in some instances, move away from traditional and familiar models. The dominant disruptors of our current era raise important questions about conflicts of interest, the strength of capital, margin and segregation requirements, the role and responsibilities of self-regulatory organizations, affiliate risk management, and of course, customer protections. As the CFTC's chair, I have made very conscious and intentional decisions aimed at ensuring that we not only exemplify good stewardship of taxpayer dollars, but also provide genuine organizational support for our valued employees. My first priority included directing an agency-wide strategic approach to human capital management focused on rebalancing and upskilling our workforce through succession planning and building a bench of future expertise through pathways and recruiting that brings diversity of thought, experience, and background. It's been over 4 years since our people left their offices and we assumed an expansive telework posture. I believe that while we have been productive and achieved success in certain mission-critical areas, we are keenly aware of the benefits of being together in person in the office. In addition, I have led reforms in how the Commission collects, interprets, and reports on market data. This data connects our infrastructure, security, surveillance, analytical, and enforcement needs and duties, and will significantly impact how we meet our mission in the tech-driven future. The CFTC has moved to the cloud, achieved significant advancement in cybersecurity protections, reorganized, increased the visibility of, and added new leaders, including our Division of Data. And our goal is the long game, building capabilities over time towards organizational maturity and technical achievement. Additionally, I'm proud to say that under my direction, the CFTC's new AI task force issued a request for comment on the use of AI in CFTC regulated markets. The proposed budget reflects the minimum resources needed for the CFTC to perform its role as a primary regulator of the U.S. futures, swaps, and options markets, and to properly enforce the law to protect markets and market participants. It provides the resources we need to ensure that the agency has the appropriate and necessary capabilities to keep up with innovation shaping our markets in 2024 and beyond. It optimizes resources to ensure the protection of market data we receive and keeps the agency's systems and infrastructure shielded from emerging risks and cyber threats. It funds oversight and surveillance responsibilities generated by an increasing number of derivatives exchanges, offering products that require consideration of new and emerging risks. Additionally, the budget ensures that our enforcement program continues its proactive approach in identifying and addressing misconduct within our ever-expanding and transforming markets. This is especially critical in light of growing retail participation and the need for greater protections in the digital asset space. As we move through 24, I'm proud of the CFTC's undeniable record of using regulation, innovation, and collaboration to ensure our markets function well and providing risk management and transparency for all stakeholders, including and most notably, America's commercial end users who rely on derivatives markets to manage risk. More than ever in these uncertain times, both domestically and internationally, we need thorough and thoughtful regulation to ensure confidence and accountability in the derivatives markets. To continue delivering results to the derivatives markets and American public, we need consistency and certainty so that we can allocate resources towards critical and multi-year investments. Thank you again for the opportunity to appear before you today, and I look forward to your questions.
Thank you, Chairman Benham. So I'm going to start with you, Chairman Gensler. You summarize well in your written testimony the mission of the SEC as, quote, the cop on the beat, watching out for the investing public and issuers. That sums up, I think, the mission well. And just to emphasize a point that you closed on, you do that without taxpayer dollars. Is that right?
Yes, we have been able to charge fees called Section 31 fees and another small fee, and then that goes to the Treasury to basically we're budget neutral.
Right. And so I'm looking at our House counterparts, that FSG subcommittee in the House, and the actions they have taken, which include significant cuts to the enforcement budget, to the cop on the beat, and a provision that would prohibit the SEC from implementing the consolidated audit trail in terms of your enforcement efforts. As I look at it, the consequence of these actions could be to significantly weaken the cop on the beat who's looking out for the investing public. Could you describe what the impact of these actions would be if they were implemented?
I think on each, it would significantly impinge upon our ability to be that cop on the beat, but also to answer questions. We get tens of thousands of filings from mutual fund companies, from companies wanting to go public, seeking accounting guidance, things like that. It's the day-to-day bread and butter of our agency. About half our agency is either examination or enforcement. Another 10 or 15% is this disclosure review. And in every place, it would be constrained. And we literally have 40,000 tips, complaints, and referral per year Now, we can't pursue all of them, but right now, in this public figures, we generally run about 1,500 to 2,000 investigations at any one time that are happening. In terms, you asked about the consolidated audit trail. This is a really important source of information for the self-regulatory organizations, for the stock exchanges, so to speak, and the agency to piece together whether somebody, for instance, is front-running a market or trading on insider information, that we can see patterns in the trading and in the securities. So both are critical to our mission.
It's been said that the consolidated audit trail discloses very sort of sensitive personal information. Could you respond to that claim?
So that's an important sensitivity, that everything that we deal with at our agency could be confidential market-moving information. But in terms of personal information, under Chair Clayton, he actually skinnied back the collection of any personal information. And the only information that goes into this consolidated audit trail is a name, address, and birth year. No Social Security information, no other details about it. It's just to know who's behind the account. I mean, if we're gonna look at insider trading, for instance, you have to know, is it Joe or Jane?
Thank you. I'm going to ask you to give me an update on a provision in law that Senator Kennedy and I actually teamed up on years ago, the Holding Foreign Companies Accountable Act. The idea was to make sure that companies, no matter where they are in the world, that are accessing our markets and using our exchanges, play by the same rules as American companies here. We had concerns, especially about what was happening in China with companies in China. More recently, Senator Kennedy introduced, and I'm pleased to be his co-sponsor, legislation to make sure that companies and executives of companies, no matter where they're operating, comply with the same processes for disclosure regarding insider trading as we have in the United States. Could you give us an update on implementation of the first and your views on the second?
Glad to. First, a shout out to both of you, because I think it was with that bill, the Holding Foreign Companies Accountable Act, that the SEC and the PCAOB was given the sufficient leverage to negotiate an arrangement with the Chinese authorities, Ministry of Finance and Chinese Securities Regulatory Commission, a statement of protocol in the summer of 22, where they would give the complete access to inspect those auditors and also bring investigations. In 21 and 22, the Public Company Accounting Oversight Board went over to Asia, actually in Hong Kong, and inspected numerous auditors. They're right now in China. I can't remember if it's in Beijing or Shanghai, but they're in China right now doing this for the third year. And for the third year, the Chinese authorities are allowing that access. Now, I would say one cautionary note: the auditing there is not as high a quality as the auditing here in the US or in Europe, but they are giving the full access to conduct the inspections. And that wouldn't have happened, I think, without the leverage you gave us to negotiate that. On the bill itself, I did take a quick look. I know that our staff has given you technical assistance, but as I understand, the bill, the Holding Foreign Insiders Act, is to close a gap because foreign private issuers, and there's about 1,000 companies that have that designation, about 1,000 European, Asian, South American issuers that have that designation. If you're a foreign private issuer, you don't come under Section 16A of the Securities and Exchange Act, which has to do with, simply put, that directors and officers and 10% holders have to file within 2 days if they're selling stock. And you're closing that gap so that if you want to have access to the US markets, you have to comply like U.S. issuers do.
That's exactly right. It's just to make sure that we have a complete even playing field, again, to protect the investing public, and that, you know, everyone's got to play by the same rules. We hope, appreciate your summary of it. That captures what it does, and we hope to get it done. Senator Hagerty.
Thank you, Chairman Van Hollen, and welcome to the two chairmen today. Chairman Gensler, I want to start with you. You may recall that last September in a banking committee meeting, you and I discussed the SEC's tortured, in my view, legally baseless interpretation of Section 913 of Dodd-Frank. And you've relied on Section 913 to justify, I think, some of the most controversial rulemakings you've done, notably the private funds rule, the predictive data analytics rule. Just last week, the Fifth Circuit struck down the private funds rule. It acknowledged what I think many market participants had warned about, other commissioners had warned about, members of the Senate had warned about. Yet you're back now asking for $2.6 billion for fiscal year 25. And it concerns me that SEC staff resources are being wastefully deployed on rulemakings that wind up not affecting the markets as you would hope. In fact, they're way outside of your remit. I'd like to ask you, Mr. Chairman, how many SEC employees, you mentioned 70% of your budget is people. I'd like to understand what percentage of the staff have been tied up working on the private funds rule, the predictive data analytics rule, the climate disclosure rule, the dealer rule, the safeguarding rule, the stock buyback rule, the best execution rule, and the order competition rule. Can you tell me how many of your staff resources have been dedicated to these more partisan, baseless, in my view, interpretations of the law?
I thank you, and I do remember the conversation. If I might say, what we did in that rule, I think, was to help investors in private funds get quarterly statements on their fees, performance, and any side deals with other investors. And it was based upon, as you rightly said, a new provision in Dodd-Frank from 12 or 14 years ago from Dodd-Frank. We thought and believed that it was within the law. The Fifth Circuit,
I think you're warned that it wasn't.
Found otherwise, and we respect, we do things within the law and how courts interpret it. On your general question about staffing, I think it's less than probably 5% of our 5,000 people at any given time that are working on rulemaking. It's people in our chief economist's office, people in our office general counsel, people in the various policy divisions, of course, the commissioners themselves. But on the order of magnitude, it could be 200, it could be 300 people in the whole agency that in part are working on it. They're not full-time. The economists are working on other things as well, of course.
Well, let's go back to how you prioritize resources, because instead of staffing resources outside of the remit, which I think that full litany of rules that I just read are outside of your boundaries and outside of your remit, you're also not prioritizing staff, and you're not prioritizing rulemaking for areas that desperately need it. And here I'm talking about setting in place a constructive set of rules of the road for the crypto industry. This is an innovative industry. It's an industry that the United States should be leading on, yet other jurisdictions in other countries are setting up rules for their ecosystems. Yet what happens here with the SEC and with the CFTC is constant roadblocks and a lack of certainty. And what's happening is that this innovative industry is finding itself increasingly pushed offshore. I don't think that's the result that we want to have here in America. And I certainly think a far better allocation of resources, rather than putting it against the private funds rule or predictive data analytics rule, would be to focus on setting in place rules of the road for innovative markets like this. I want to take, for example, the years-long process that it took to approve Bitcoin's ETF. And that only happened recently. And it happened in the wake of a court finding that your grounds for disapproval was warrantless. And I'm just very puzzled that in light of the most recent court ruling, why we haven't fully approved the issuance of Ether ETFs. Chairman Benham, I'm going to turn to you. Is Ether a commodity? A yes or no answer will do.
Yes.
Chairman Gensler, same question. Is Ether a commodity?
Senator, we actually, as an agency, did approve Ethereum exchange traded
Only
products.
partially. It's not, the approval is not complete.
Well, we address ourselves to the filings in front of us, and we approved it. And
So you're saying that all Ether applications have been approved by the SEC that are pending
the
right now?
Ethereum exchange traded product of filings that were in front of us from stock exchanges, I think there were 8 or 9 of them, were all jointly approved. Individual issuers still are working through the registration process that's working smoothly, and I would envision sometime over the course of this summer, those are just
That's
disclosure
great news.
documents.
If you're committing to me that those applications will be approved by the end of the summer, I appreciate that. We've got to get this market.
Yeah, we've
place.
already approved, and if I can say just a little bit further, the Ethereum exchange traded product, we actually last summer had already, based upon a well-regulated market, the Chicago Mercantile Exchange has Ethereum futures contracts that are 3 or 4 years old already. Based upon that well-regulated market, even last summer, we had, there were Ethereum exchange traded products, it was called ETFs, based upon those Ethereum futures last summer. That's already happened.
Well, I take it from your answer then that the applications that are still pending for Ether, this would be very helpful to the marketplace to get this clarified, that you're ready to approve those. You'll get those done this summer. Is that what you said?
Again, that's done at a staff level, but it's just disclosure and registration, and those registration statements have to have the proper disclosures and go through before they go what's called effective.
Well, the
But we've
Bitcoin
already,
ETF
as a
approval
commission,
was
already
important.
approved the
Ether needs to be
ETP.
approved as well, completely. I'm going to move quickly on to another question here that I've got, and that has to do with, and Chairman Von Hollen brought this up, the consolidated audit trail data. And I think this is a concern, Mr. Chairman, that a number of us feel. It's an extensive amount of data, billions of dollars worth of equity and option trading data, and it does have personally identifiable information on investors associated with that, as you mentioned, Mr. Chairman. But I think all of us are concerned. If we look at other agencies, for example, the IRS, the IRS has had a very terrible track record of being able to maintain and protect individual taxpayers' data. There's a person sitting in jail right now who disclosed thousands of taxpayer returns in their data just so they could go after political enemies. You think about the FISA context. We found out that in 2021, the number was 278,000 times in 2021. There was unauthorized access of Americans' personal data, including political figures. And so there is a deep concern there about this type of data availability, what's being done to protect it. You mentioned at any time you've got 1,500 to 2,000 investigations underway, presumably relying on this data. What are you doing to protect it? And what law requires you to protect it and to penalize anybody that might disclose it?
It's a very important matter to us. First, only a limited number of people at the SEC even have access to
Could you give us the numbers, Mr. Chair, to give a sense for that?
It's less than 3 or 4% of the agency. We can come back to you and give you, but it's in that 100 to 200 range. So it's not even the whole 1,300 people in enforcement, to give you a sense. It's a much narrower group of people, and that's they all go through particular training and so forth of how to access it.
How do they get permission to access it?
With respect, so we have 7 minutes allocated for colleagues. We're about 1:45 over here in terms of exchange. If you wouldn't mind just a quick answer, because I just want to make sure we get to other members. I don't know if, and we're going to have another round. Okay. I have 7 minutes so people could have plenty of time. Now we're okay.
And I'm also willing, Senator, to meet with you later today or tomorrow, or to get on the phone and chat this through with you, or any other matter with you.
Yeah. No,
we can come back to it on the second round too. I just want to make sure. So let me pick up, if I could, Chairman Gensler. Senator Hagerty raised the issue of crypto assets, cryptocurrency. Obviously, this is an area where Chairman Benham has been involved as well, and we all are very aware of the fact that there's a big debate going on Capitol Hill right now regarding whether these things are fish or fowl and which agency should have jurisdiction. But I would hope that we would all be able to agree on a couple things, which is that we want to protect consumers and the public, number one. And number two, however we move forward, we deal with the anti-money laundering equivalent part of this, making sure that these assets cannot be used for nefarious purposes. So again, our House subcommittee counterpart included a provision, Chairman Gensler, regarding SEC crypto regulation. And specifically, it reads, none of the funds made available by this act may be used to carry out an enforcement action related to a digital asset transaction, except for enforcement actions related to fraud or market manipulation, unless, and it goes out and sets out some conditions. Could you speak to what the consequences would be with respect to the goal of protecting consumers and the public if this were adopted?
It would be seriously undercut our efforts. While not all crypto or crypto securities, some are under Chair Benham's jurisdiction, those that are have an obligation to disclose to the public. It's called a registration to disclose to the public full, fair, and complete information. We'd lose that. Secondly, intermediaries, so-called exchanges, broker-dealers, and the like, register, and then the public gets protection. For instance, a really key protection is that your funds are segregated and protected. And so our securities laws are not solely about fraud and manipulation. Stamping out fraud and manipulation is really important, but it's also about, if you register, in this case, a crypto security token, you have to then give disclosure so the investing public gets the benefit of that. If you register a crypto broker or crypto exchange, you get the benefit of things like segregation. You get the benefit of a rule book on the exchange, like we have on, let's say, the New York Stock Exchange. There's a lot of benefits, but it would also undercut ongoing current cases that we have in front of courts right now. And we've been very successful in a number of these cases where, at least on the law, on motions to dismiss and so forth, the judges have found we've got the appropriate reading of the law, and then they'll move on to the fact part of the cases.
So just to be clear on that last point, this would interfere directly in ongoing cases.
It would interfere directly on ongoing cases that we have in front of various various district courts.
Thank you. So, Chairman Benham, I mentioned the importance of making sure that these assets, currencies, cannot be used for nefarious purposes, and the need to apply the equivalent of the anti-money laundering standards to these assets, regardless of how we decide to treat them. Would you agree with that? And what measures should we use? Should we just simply apply existing AML provisions to these currencies?
Senator, thanks for the question. You know, from a CFTC perspective, and as I've said publicly for many years now, it's a legal authority issue. We, to Chair Gensler's point in the earlier question, have anti-fraud and anti-manipulation authority for digital commodity assets. So we've been quite successful over the past 10 years, really, in bringing enforcement cases. But the weakness that we have, or the shortcoming, is that we have to rely on folks coming to us, providing tips and complaints. We don't have those traditional regulatory tools, registration, custody, surveillance, oversight, that have really made American capital markets and derivatives markets so strong. As it relates to AML KYC, again, it's a legal authority issue. If Congress were to move on some authority for the CFTC, certainly that would be a key component of this, given what we've seen and experienced in this digital asset space around AML and KYC. I don't think we need to stray too far from existing law. A lot of AML KYC enforcement is conducted through the Treasury Department. We work very closely with FinCEN on certain authorities we have, but it is limited in scope. But I would think, you know, the current AML KYC structure at a bare minimum is adequate. I do think the technology would require some rethinking of how we need to consider both anti-money laundering and know your customer.
Thank you. Chairman Gensler,
Could I just
comment on
say,
that?
one of the real challenges is that these crypto tokens are transferable outside of the traditional financial sector on what's called permissionless ledgers. And so one of the real challenges is it's not as easy to apply the anti-money laundering laws. So for instance, Bitcoin is the token of choice by ransomware attacks. I mean, that's the, pay us in Bitcoin. And you can imagine there's a whole cottage industry in, Eastern Europe preying upon U.S. companies.
Thank you. So Chairman Benham, last year I joined with several of my colleagues here to send you a letter urging you to reject a pending proposal by a private prediction market operator that could allow for legal gambling on U.S. elections and their outcomes. I was pleased to see the CFTC reject this proposal shortly after. I understand this is an ongoing matter, but could you just speak to the potential harms of legalized election gambling, given all the challenges we're already facing to our democracy today?
Thanks, Senator. And you make the point directly. There's a lot of issues around election integrity, and from a agency perspective and from an existing legal perspective, there are certain parts or products that are prohibited to be traded on CFTC regulated exchanges. Quickly, anything that has to deal with war, assassination, terrorism, anything that's against federal or state law, against the public interest, or as you point out, something like gaming. So the commission has long held a position that prediction markets or derivatives contracts on elections are illegal. We've faced a number of entities, as you suggested, that have continued to want to list these contracts. We have stayed them in certain circumstances. We are facing litigation in other circumstances. But more recently, just a few weeks ago, we proposed a rule that would ban prediction markets on election contracts. And I think the one thing this committee should know, and your colleagues throughout the Senate, is, as we pointed out in the digital asset space, our authority over non-traditional assets, or assets we don't have direct oversight over in the cash or underlying market, is limited to fraud and manipulation. So in an instance where you had a derivative contract that was based on an election, local, state, or federal, if there was allegations of fraud or manipulation, whether it was a news story alleging a candidate was ill or was not running, or some news story that wasn't necessarily accurate, a voting machine perhaps was broken and sort of deterred folks from voting, we then, the CFTC, because of that allegation of fraud or manipulation, would have to police that market. We'd have to police that allegation, because that allegation, whether true or not, could have an impact on the markets we regulate. So to your point about election integrity, I think the last thing we need right now is sort of commoditizing elections. But again, more clearly, this, in my view, is clearly against existing law, and we're taking steps to make sure they're banned.
Thank you. And I see we went over a little bit here as well.
Mr. Chairman.
Are you next, Senator Kennedy or Senator Bozeman?
No, I think Senator Bozeman is, but I just want, I love you like a brother, Chris, but John and I'd like a chance to ask questions.
No, he's not.
Well, that's what I'm getting to
I
now.
know.
I think the question is the order. If there's not another Democrat here, I think it was my staff just raised it with me too. We should let the other Republicans go before. Are you going to
okay.
go back and forth?
We'll figure this out while whoever is going to go next is going to go next. I mean, the normal pattern is to go back, but we want to be accommodating to members.
Yeah.
So who is next on your side? Senator Kennedy.
Okay, I'll try to be as quick as I can. Mr. Chairman, welcome. Thanks for being here. You're both looking well. Chairman Genzo, do you remember, I know you do, back in October 2020, Ant Group, a subsidiary of Alibaba, announced an IPO. And everybody was all a titter, going to invest in this extraordinary IPO because Alibaba is such a successful company. And the CEO of Alibaba got crossways with President Xi. And unsurprisingly, President Xi won. And he canceled the IPO he meaning President Xi, for Ant Group, the subsidiary of Alibaba. And of course, after the announcement of the cancellation was made, Alibaba stock dropped about 8%. You remember that? I did some checking, and 2 days before the announcement that the IPO was canceled, a bunch of insiders at Alibaba dumped about $150 million worth of Alibaba stock, therefore avoiding an 8% loss, which other investors who didn't know about the IPO cancellation had to swallow. Insider trading. And I said, how can this be? Well, our law provides, I'm not blaming it on you, this is Congress's fault. Our law says that if you are the CEO of an American company and you sell your stock, you've got to report it to the SEC within 2 days of the sale, and you've got to report it electronically. You can't use snail mail. And you post it there in front of God and country on your internet, on your website. But a foreign executive doesn't have to do this. The foreign executive, he has weeks to inform you that he's executed an insider trail, and he can then send it to you by snail mail. And it's not even posted on the website. So Senator Van Hollen and I have a bill to basically say the foreign investors and the foreign executives have to follow the same rules as the American executives. I mean, insider trading is insider trading. Will you support that? We talked to my Democratic colleagues.
I think that you're addressing something, Senator Van Hollen, and you are addressing a gap in our current regime. We have about 1,000 of these foreign private issuers, and you're right that they don't have to currently file within 2 days electronically their trades, and I think that would help close a gap. There's another gap that's actually a 25-year-old rule, and I've asked staff to look at, called Regulation Fair Disclosure, or FD, when it was under Chair Levitt some years ago that he put it in place. A simple concept. If you share material non-public information to analysts or Wall Street or to the press, you've got to put it out to everybody. And it's helped protect the public. Fair disclosure. But guess what? There's an exemption there for foreign private issuers as well. So I've asked staff to take a close look. We'd have to go through notice and comment rulemaking to change that.
Good idea. Well, we're going to try to move our bill by UC, unanimous consent. I can't imagine anybody will object, but I've seen it happen before. So any help you can give us. I wanted to, last weekend, I know I need to get a life, but I sat down and read Judge Englehart's opinion in the, I forget the name of the case, National Association of Private Funds Managers v. SEC. It's the private funds rule case. And I thought the opinion was, regardless of what you think about the result, I thought it was well-reasoned, well-written, far-reaching. And I wanted to get your thought, and I know the Fifth Circuit en banc can change it, and the Supreme Court might review it, but I wanted to get your thoughts about the consequences of the holding in that case, holdings, on your other rulemaking procedures.
I'm glad that you read the case, and of course it's in the Fifth Circuit, it's in New Orleans. So. Yeah. But we're still reviewing and thinking about our next steps. But I think that what it said, and Senator Haggerty and I were talking about it, is this new provision 14 years ago in Dodd-Frank, Section 913 of that. Which is
part of the Advisors Act.
Part of the Advisors Act. You might remember it's 211H of the Advisors Act.
Yeah.
That talks about new authorities about investors. The court read that to be just about retail investors. And so we're looking at that, but, if you're asking me, that means that narrows that authority. Of course, we do everything within the law and how courts interpret it, but we're just still thinking about the next steps. But it would narrow that authority to, I think as they read it, I'm using a colloquial word, retail investors.
One of the things, Mr. Chairman, that got my attention, and you can debate whether it's part of the holding or not, but the court seemed to seize on the fact that in terms of your fraud rule, based on the SEC's experience, out of the thousands and thousands of these private funds, you've only found 0.5%, not 5%, 0.5% instances of fraud, but yet the requirement to comply with the private funds rule was going to cause the private funds industry over $5 billion a year. Obviously, it was a cost-benefit analysis. That made sense to me. What do you think?
Well, with all respect to any court and so forth, we put certain things in a filing and we listed, I don't remember, a couple dozen examples. They're exemplars. We in our enforcement, and what we do in enforcement is we have cases when it comes to our attention and we pursue that fraud, and then we either settle or we litigate. And so we were giving some of those examples. But again, we're still looking at that case. We're looking at the opinion, trying to determine what next steps. But I think that in any area in the law, if we have examples of fraud, that's to help protect the public. And it's not whether there's tens of thousands of them, but what in that case, a couple dozen real cases that we were able to point to.
But the question was being raised, and I'm going to shut it down, Chris. Cost benefit, okay? And the court was saying that there are only 0.5%, half of 1% instances of fraud based on SEC experience. But the SEC issued a rule that was going to cost everybody $5 billion a year. And does that make sense? And I think it was raising that issue.
Well, we address ourselves to cost benefit, I think, in a very serious way as to what problem we're trying to solve. In this case, what we were trying to solve is information for the limited partners investing in private funds. And behind those limited partners, of course, are pension funds, endowments, your state pension funds probably in your states. To have quarterly reports to them on the performance fees and arrangements with other investors. And this was not meant to be public information. It was just private information to those. I think that would promote greater competition and efficiency in that market. But again, the court had a different view on this important Section 913.
Thank you, Mr. Chairman.
Thank you, Senator Kennedy. Senator Durbin and then Senator Bozeman.
Thank you, Mr. Chairman. It's good to see you both. Most people know, but it bears repeating that the CFTC in particular has a special connection to my state and city of Chicago. Mr. Gensler, having served in that capacity, you know that full well. And the SEC, of course, is a highly respected institution as well. Thank you for being here today. There's a difference between the way that your two agencies are funded, is there not?
As I understand it, but having had Russ's seat and having once had that special relationship with Senator from Illinois, we're fully funded or budget neutral because of fees we can assess on transactions.
Chairman Benton.
We do not have a user fee. We're appropriated on an annual basis by Congress.
And as I understand it, in the president's request, $2.6 billion for the SEC, $399 million for the CFTC. Is that about right?
Yes.
Yes.
I raise that point as my initial observation because I want to join the chorus in asking about the future of crypto. This is an amazing phenomenon. 88% of the American people have heard about it. 1 in 5 have invested in it. 75% say they are not confident in the safety and reliability of crypto. 45% report that their investments have performed worse than they had expected. And most do not realize that there is no insurance involved in this, no federal guarantee. You're on your own when you go into crypto, correct?
Yes.
Yes, it's a field that's rife with abuse and fraud, and at least in the those tokens that are crypto securities are not properly giving people the disclosure that you'd get for any other offering.
You've been quoted, Mr. Gensler, saying it is rife with fraud, scams, and abuse. I think you just about repeated that.
Yes, and some of the leaders 2 years ago in this whole field are either in jail, about to go to jail, or awaiting extradition. I mean, tens of billions of dollars have been put at risk.
Despite the House bill, Chairman Benham, we have those who worry that the CFTC is biting off a hell of a lot more than it can chew when it says they want to play in crypto and regulate the industry, at least some aspects of it. What in the world makes you think that you can get into this fast-moving, capacious world and be effective as a regulator?
Senator, using the word play, I think I would sort of disagree with that respectfully. This is our responsibility. This is my responsibility as chair to make observations about commodity markets and to relay what I observe to all of you. And currently, there is a gap in regulation over non-security commodity tokens. Our enforcement record at the CFTC, I think, demonstrates our success and our expertise. Over the past 10 years, we brought 135 crypto cases. We've brought in billions of dollars, and we've successfully policed a market where we don't have direct authority or jurisdiction, which ultimately leads to all of this fraud and rampant abuse in markets, and ultimately public mistrust, lack of confidence, and loss of funds. So we are one of two market regulators in the US financial system. We are adequately equipped to oversee the markets that we traditionally oversee. Yep.
What makes you think you're adequately equipped to deal with this market?
Finishing that statement, we are adequately equipped to oversee the markets we are mandated to oversee. But if we were to be given authority over crypto markets, I would certainly expect there to be an increase in a budget.
Let me ask you, Chairman Gensler, do you have, having lived the life of chairman of the CFTC, do you think that agency is capable of handling the responsibilities we're talking about?
I'm going to be conditional. I think it depends on what they're given. I think that the Congress's wisdom was to have an agency to oversee disclosure-based markets where issuers are asking the public to buy and sell their securities and are investing in those. And most of the crypto market is that. There's 15 to 20,000 of these tokens, and without prejudging any one of them, most investors expecting to benefit from the efforts of others. That disclosure-based regime has not been set up at the CFTC. The CFTC I love. It's a great agency, but it was set up to do the derivatives. There's not disclosure, for instance, mandated, required, nor has Congress suggested on corn, wheat, oil, or interest rates. So it's this disclosure-based regime that we have at the SEC. And I would say that largely the crypto field has been thumbing its nose at it and been non-compliant.
And the differences are not a significant difference when it comes to the investigative resources and mission of the SEC as opposed to the CFTC?
I think, having had the honor to chair both, I mean, they're both great agencies. We do have about, I don't know, maybe 9 times the staff or so, roughly. So we've got a greater remit. And also our standards and rules around exchanges and protecting the public, that there's not as many conflicts. You know, the New York Stock Exchange can't trade against their customers and run a hedge fund on the side, as sometimes happens in this crypto field, for instance. And so the New York Stock Exchange can't actually also run a hedge fund and trade against their customers or make markets ahead of their customers. But in the crypto field, that's what's happening on a lot of exchanges. That they're commingling all these functions. They're taking the customer's assets, so they're taking custody. They're often then using those assets and trading against them. I mean, it was very public what happened in FTX, but that is not unique. It's happened in multiple places, that there's this commingling. The intermediaries are really presenting themselves as exchanges, but they're doing an awful lot of other things to put their interest ahead of their customers.
So they're telling their customers, go long. They're telling their internal investors, go short.
They may be, depending upon the company, depending upon the day. They may also be buying into the tokens and then listing them. And when you list a token, you get a pop in the value of the token. And so that's good for the intermediary in the middle as well.
Seems it's like a chia pet. It looks like a good idea for a gift until you buy it.
It's really, this is a field that's not serving the public well right now.
Mr. Chairman, I yield.
Thank you, Senator Durbin. Senator Bozeman.
Well, thank you. That's hard to follow. We appreciate you all being here very much. I'd like to start with the cat. And my understanding is, prior to the consolidated audit trail, if Aunt Sue bought a stock, that information remained with her and her broker. Now it's going to you, the SEC and FINRA. That seems to be very much Big Brother. My main concern is I don't think the SEC has the authority to set up the CAT, but I'm also concerned that SEC and FINRA don't have the ability to secure it. When I was working with you, when you were at CFTC, we had the OPM breach, we had the SEC breach, the list goes on. And again, I don't see any special ability of yours to secure that information, nor is the need for that information to be brought to a central depository unless you've got a problem. And then, you can subpoena it or do whatever you want to do. On top of that, FINRA has no accountability, no oversight, which is a huge problem given their pay scale and remote work schedule. So we're going to be writing a letter about that and see if we can dig into some of those things. I was going to ask the question about how many people have access, but you mentioned 100, 200. You don't even know, how many people have access to the data that's coming in. So maybe you can tell us how often they're using the CAT data and how many enforcement cases have been used as a result of the CAT data.
I thank you for the question and reminding me about when we worked together when I was in that chair.
Right.
But in 2010, when I was in that chair, there was something called the flash crash. And one of the things that happened as a result is that CFTC within 24 to 48 hours understood all the movements in the futures, or at least had the data. We had to analyze it. Good staff takes time to. I was struck when I was in Russ's job at the Chair Benham's job at the time. The SEC did not have that ability to have the data to assess what happened. It took months of special calls and getting the data. So that's what Chair Shapiro tried to address back then and wrote a rule, notice and comment rulemaking long ago. I came in 2021 and the consolidated audit trail had already been stood up. There's a national market system plan on that. In terms of your specific question it's a narrow group, and I did say to Senator Haggerty, we can come back to the specifics. I just didn't want to misstate if it's 122 or 142. And there's a lot of limitation on people using the data and tapping into the data, even at the SEC. In enforcement, it's not everybody in enforcement. It's not everybody in our trading and markets. It's very limited. But the reason that it's important information is we have a market system that has, and I might be off, like 15 to 20 different exchanges. I mean, we all know the big ones like New York Stock Exchange and NASDAQ and Chicago Board, but there's multiple exchanges and trades can go across these different venues. And so it's tying it together, thus called the consolidated audit trail, something that Chair Benham had, the Chicago Mercantile Exchange and could get that data more readily, as I remember it 14 years ago. So that's where it helps us. In terms of the number of enforcement matters, from time to time, we do include that in a public release. I mean, there's some notable ones in insider trading where the data itself helped us understand what was happening
So how
in the
many?
markets.
How many? How many?
I want to be careful because I have to think about how many have we publicly disclosed in the enforcement matter that some of the information came from CAT, which is a smaller number than actually has been used. So I think I'm just have to be careful and come back to you, but it is an important tool that's used by our market oversight. And also, if I might say, the stock exchanges, and there's 8 different stock exchange groups that use it for their market surveillance.
Well, we could eliminate a lot of problems if we knew what everybody was doing all the time. But we have protections, in place, or should have protections in place as to prevent, again, this 100, 200 people having the ability to pour through data. And then the other concern is the security. And I think that's a huge issue. And I don't think, I simply don't think you have the ability to do that. Chair Benham, interest rate volatility is up and U.S. firms want to hedge their interest rate risk through derivatives clearinghouses. I know you agree that incentivizing clearing is a good thing, but U.S. customers are prohibited from clearing rates in several foreign jurisdictions, including Japan and elsewhere. The problem is that foreign customers aren't prohibited, so U.S. customers are at a disadvantage. Will you commit to allowing U.S. customers the ability to hedge their global interest rate risk to ensure a level playing field?
Thanks, Senator. We have a very clear regulatory structure around access to U.S. customers. This is all driven around customer protections and bankruptcy protections. And as we at the agency evaluate non-U.S. clearinghouses who have the ability to register with the CFTC fully or fall under an exempt clearinghouse model, which was created in Dodd-Frank 14 years ago, we have to respect those boundaries of bankruptcy protections and customer protections, which I think you and your colleagues can agree are the sort of pinnacle of what we do and what we care about. So as it relates to U.S. customers and access to foreign markets, I certainly commit to working with other jurisdictions, other institutions who want to register with us fully or fall within an exempt classification. But I feel very strongly that whatever we do with respect to non-U.S. entities who want access to U.S. markets, we have to ensure that the same protections that apply for U.S. entities, whether it's a U.S. clearinghouse or U.S. broker, an FCM, or U.S. exchange, apply to those non-U.S. entities. And there are certain jurisdictions that don't necessarily have parallel bankruptcy law or parallel regulations that would either allow them to register with us fully or provide those bankruptcy protections, which are paramount to U.S. derivatives laws.
Thank you. Thank you, Mr. Chairman.
Thank you, Senator Bozeman. So for those interested, we will do one more round. And the way we're going to do it is we'll have Senator Hagerty, Senator Kennedy, Senator Bozeman, if he wants to stay, and then I will ask my round of questions last and close out the hearing. Senator Hagerty.
Thank you. I'm going to come back to the exchange, Chairman Gensler, that you just had with Senator Durbin. I think it raises an interesting question. It may seem like a broken record, but this is a serious concern of mine. You were describing the circumstances around FTX in its ability to do many things that I think have upset most regulators. It should, the Wild West manner in which they are performing. But I think there's a root issue here. What jurisdictions did FTX choose to domicile itself in?
They had legal entities here in the U.S. They had legal entities overseas. And this is, I think you've hit.
They were in Hong Kong and Bahamas.
Yeah.
That's where their operations were located. The presence here in the United States was minimal, and I think that was intentional.
But they were offering and selling securities to Americans here in the U.S. You could access through websites, and this is the case for a number of these other crypto exchanges as well. They're trying to paper it and layer to make it harder for agencies, both of our agencies, to bring be the cop on the beat. but American investors are accessing them here in the US and under
I know
our authority.
that's a grave concern. I just think that the important thing here is that FTX chose to avoid the US market because we don't have certainty here. We don't have regulatory clarity here that would allow these exchanges to come and operate clearly. And as I mentioned in our first discussion, it's a matter of resource allocation, in my view, at the SEC, in allocating resources to put in place a clear and constructive framework for the ecosystem to exist here, to have the resources necessary to do what you described with Senator Durbin, I think would be very big help.
I appreciate what you're saying, but I'm with all respect, going to differ with you. They did not avoid U.S. jurisdiction. I mean, Sam Bankman-Fried's in jail right now, so they didn't avoid U.S. They might have trying to,
but they harmed U.S.
And they
investors.
did. They did in other crypto exchanges, I believe, are putting at risk Americans. But it's not about just jurisdiction.
But had they been subject to a set of laws and enforcement provisions right here, I think we would have been on top of it much sooner.
They are currently subject to Congress's laws written over 90 years called the Securities laws, Commodity Exchange Act laws. I'm not going to leave you out, Russ. They are subject to those laws as it relates to crypto security tokens, which again, without prejudging anyone, I think the vast majority of these are. They're subject to the laws right now, and they're not giving the proper disclosure to your constituents, and the crypto intermediaries are improperly commingling. And we're in court right now pursuing those. And I believe Americans would be better protected. So it's not about, there's nothing about crypto that's inconsistent with the securities laws.
It's the exchanges, and exchanges can't get through the process here because it's become so difficult. It's been made so difficult for crypto exchanges to flourish here, to register here, and to operate. And I'm encouraging.
That's with all respect, that's because they are choosing to try to not comply with U.S. law that so well protects our capital markets. And I would go a little further. We have taken up and written some rules in this area where we think it was appropriate, and talked about the application, whether it's in custody, whether it's in what's called dealers, and when are you a dealer, and so forth. And so we have, in certain circumstances, done that. But in the main, whether it's stored on an accounting ledger called blockchain technology or stored on a notepad, doesn't matter. It's the economics that matter. Is the investing public investing, anticipating profits based on the efforts of others?
What actually does matter is having clarity here in this marketplace. That does not exist. I can tell you from talking to many market participants, we don't have adequate clarity, and they can't get answers out of the SEC. So again, I'm going to finish this line of questioning and move to something else, but this is something I want to encourage you to focus on. This industry needs to have a proper ecosystem here in America so that we're not shoving it offshore.
If I can say, breaking the law and not liking the law are different than lack of clarity. And with all respect, I think that's what we have a lot in this field.
And we also have a lot of uncertainty and a lot of lack of clarity coming out of the SEC in terms of how these applications are being evaluated. There's a lot of mystery around it. It need not be that way. To come back to another point that Senator Kennedy raised regarding the Fifth Circuit ruling, it raises a question in my mind, is how you balance the risk at the SEC of losing in court versus the allocation of resources that it takes to undertake these rulemakings that I think you probably know are going to be subject to the type of scrutiny and the type of resistance because of the controversy that they raise.
It's on my mind on a very real basis, sir, and has been for my whole 3 years in the job. But I really do think it's such a privilege to serve, and the important thing we do is we look out for 330 million Americans. And in this field, this ever-growing field, $30 trillion of assets under management, more than the whole U.S. banking system. What we believe, and I still believe, that to have greater transparency so that once a quarter investors know their fees, performance, and your arrangements with others, that will help promote greater competition and efficiency, lower the cost.
We're talking about very sophisticated investors with respect to the private funds rule, very sophisticated players in the marketplace, and plenty of competition is noted by how many thousands of funds exist there. Last question I'd like to ask you, and this gets to a concern I think we have for many of the agencies here in Washington, and that is the effort to get people to come back to their office. And in April of last year, the OMB issued a directive to get 50% of the staff back into their offices. And I think the OMB and the White House expect this to occur. And I'm interested in how the commission is thinking about compliance with this rule. Where are you? And to let you just wrap it up, are there real estate implications for this that we need to be considering?
All very good questions. We, when I was honored to take over the commission, we were in mandatory remote, and we then, Chair Clayton had done that because of COVID. We then entered into negotiations with the bargaining unit, the union, and went to impasse. There's a federal impasse panel, and as a result of that, we have an arrangement through 2026. So it was entered into in 2023 that staff have to come in 2 days a pay period. You can think of it on average 1 day a week. That was the result of the impasse, and that runs through the end of 26. In terms of real estate, we have been shedding real estate. We shedded one of the buildings here in DC. We had 3 buildings. Saves about $14 million a year. We've shed a space in New York. I think we're going through something in Chicago right now. And we also just announced last week that we would be closing the real estate in our Salt Lake City office as well.
Got him. Thank you. Thanks, Mr. Chair.
Thank you. Thank you. Thank you, Senator Haggerty. Senator Kennedy. No, go ahead. I'm going to wrap it up. I'm going to wrap it up at the end. Yep. Thanks.
To National Association of Private Funds Managers, BSEC, the Fifth Circuit opinion. And again, I realize it could change in an en banc hearing, and I realize the Supreme Court could make changes. But I was reading, as I said, I read it this weekend, and then I was reading a bunch of the analyses on the internet. The court gave a very narrow interpretation of sections of the Investment Advisors Act. And I'm thinking about sections 2064 and 211H. I know that's kind of inside baseball, but I know you know those. The narrow interpretation of those sections, your proposed predictive data analytics rule, what effect, if any, do you think the Fifth Circuit opinion will have on that rule?
Again, I think you'd appreciate if I say that our staff is still reviewing the Fifth Circuit and will give advice to the 5-member commission under General Counsel Barbero's leadership. I've also want to note for you, you may not be aware, we got a robust comment file on the predictive data analytics rule. A lot of people for, a lot of people against, raising different issues about the scope of that rule. And I had already asked staff to consider whether we should either reopen or repropose that rule given the breadth. And we even did, and I say this, Chair Benham might not be aware, we did that on a safeguarding rule as well, and we had been talking a lot. I've asked staff, should we reopen or repropose that safeguarding rule as well? So while we're considering that on the predictive data analytics, we'll also get the best advice from our general counsel around the Fifth Circuit opinion.
Do you ever issue a rule where everyone says this is just splendid and we're all happy?
No,
You generally get comments.
I would say to get my vote, yeah. I'm only one of 5, but I really strongly believe in our constitutional system. Do it by the law and how the courts interpret the law, and we present ourselves to the American public, and that's important to the trust in the system. But if the courts see it otherwise, we adjust.
Sure. What about the impact of the Fifth Circuit ruling on your outsourcing rules?
Again, I'm going to defer to getting the best advice from our Office of General Counsel, our Division of Investment Management, and sorting through that. And in any, not just this Fifth Circuit, any ruling by a court, sometimes not even related to the SEC, we take a look at it. Does it have an effect on something that we've already put out there, and do we adjust?
Yeah.
And I just think that's part of our great democracy.
So you just can't say yet. Would that be fair?
That would be correct on the outsourcing rule.
Okay. Well, the language that the Fifth Circuit used is also present in the Exchange Act of 34, isn't it?
If you're referencing Section 913
Or
of
the language
Dodd-Frank,
interpreted, yeah.
put the similar language in the Exchange Act, both in what's called 211H of the Investment Advisors Act and a compendium similar language in the Exchange Act.
Yeah, I misspoke. I should have said the language that the court interpreted is also appears in the Exchange Act of 34.
One of the provisions, the 211H.
Well, that language that the court interpreted in the Fifth Circuit also appears in sections 9J, 14E, and 15C2D of the Exchange Act of 34. So it could implicate your rulemaking authority under those provisions too, couldn't it?
Again, I'm going to look to General Counsel Barbero and her team and of course the divisions of trading and markets and investment management for good advice, and all five of us will.
Okay. Does commission know yet what it's going to do? Are you going to ask for an en banc hearing or appeal, or have you decided yet?
It's commission has not yet.
Would you tell me if they had?
Yes.
Of course, of course. Thank you, Mr. Chairman. I enjoyed talking to you. Thank you, Mr. Chairman. You're doing such an extraordinary job. I didn't have any questions. Van Hollen told me to say that.
That's good. When I was here 12 years ago, Mary Shapiro got all the questions too.
Thank you, Senator Kennedy. Chairman Benham, a couple times it's been referenced that the funding mechanism for the SEC is different than for the CFTC. The SEC collects some fees from those that it oversees and regulates. CFTC does not. I think the president's budget includes a provision that would include at least a component of the funding from fees. Do you have a view on that as the chair of the CFTC?
Well, I think certainly it would provide consistency more so than what the agency has dealt with over the past 15 years. I think given our constituency of market users, Congress would need to be careful about how they craft the language with the user fee to ensure that we're not impeding or creating essentially barriers for commercial end users to be using our markets. As I mentioned earlier, and as you noted, these markets are critical for risk management, which has a direct impact on our economy, economic growth from agriculture, energy, financial services, and whatnot. So I think as Congress continues to contemplate this, because this is an issue that's been going on for, I think, 4 decades across both Republican and Democratic administrations, whatever is considered would need to be carefully crafted to ensure it's not having a negative or unintended consequences.
Thank you. I appreciate that. It's something obviously we're talking about, but would obviously also talk to the authorizing committees and with you before we pursued anything like that. Chair Gensler, just a couple more topics. One has to do with the insider trading rules, and thank you for your leadership at the SEC with respect to the 2022 rules amending the 10b5-1 provisions of insider trading, the safe harbor provisions. I've worked with Senator on a bipartisan basis here on trying to make sure we tighten those. You've obviously heard about Senator Kennedy's and my bill with respect to applying the same rules to entities conducting business overseas. I did see that in April, the SEC secured a jury verdict in your first shadow trading action. Shadow trading being when a corporate insider trading shares on an economically linked company while in possession of material non-public information about the insider's own company. Are there other additional areas that we should be looking at together with respect to insider trading, abuse of the safe harbor rules, other provisions that you think that we should be taking a look at?
It's a very good question, and because it goes to the core of like, how do you have trust in markets if there's material information, material non-public information that somebody's trading on and others aren't. As I mentioned earlier in the exchange with Senator Kennedy, I've already asked staff to consider a 24-year-old decision that was made by the Commission on Regulation Fair Disclosure that, at that time, that it didn't apply to foreign private issuers. And we'd have to go through notice and comment rulemaking to change that. But I think that that's one area that I think's ripe to be looked at. I think also, if I might say, artificial intelligence, just if I can say, which it's interesting, a whole hearing, and it hasn't come up, I think, yet. Chair Benham raised it about how it's affecting the markets. But I think in the context of the real transformative power of predictive data analytics, it's also going to raise new challenges about how people are using information and where is that line as to what's material non-public information if you're using data and assessing things. Of course, this hearing itself is probably being analyzed by predictive data analytics. And your smile right there might be analyzed as to what law you'll support. But I'm talking about if it's inside information. And I think there'll be new challenges in that field. And of course, fraud is fraud, regardless of whether it's a human doing it or it's a computer doing it.
No, I appreciate that. In fact, hearings in another committee, I serve on the Banking and Housing Committee. I've raised those issues, in AI issues, in connection with market manipulation. I think it's a really, really important point you're raising. Chair Benham, do you have any comment on that specifically? And then I have one last question for Chair Gensler.
Yeah, we've, as I mentioned in my opening statement, and Chair Gensler alluded to, we put out a request for comment on artificial intelligence. It's not new to financial markets. These are some of the most sophisticated companies in the world, and they're using data and predictive analytics to get an edge. The question is now, with our existing suite of laws and regulations, is it appropriate as AI continues to evolve and become more present in everyday life, especially in markets? And it's going to bridge gaps between retail investors and institutional investors, and it's going to create, I think, blurry lines about how we're able to oversee markets. And we, as a regulator, in addition to seeking feedback from the market about what we need to do from a policy perspective with the existing authorities we've actually been quite successful using data analytics, predictive analytics, and AI generally in our enforcement and surveillance programs. Some very basic things, but first steps, and I think foundations for what will really catapult the agency to, as best we can, keep parity with a really fast-moving market.
Well, no, I'm pleased to hear that. And, clearly the CFTC, SEC can make good use of AI tools to better do your jobs as well. So, Chairman Gensler, this has not come up either, other than Senator Hagerty referenced it in passing, but I'm just pleased to see you and the SEC move forward with the climate risk rules. Could you just very briefly describe why it would be important to an investor to have these kind of disclosures with respect to climate risks?
It's important to investors because investors think it's important to them. We are a merit neutral regulator. We're not a climate regulator, not an environmental regulator. But what's interesting is in our capital markets today, of the top 1,000 companies by size, by market value, 90% of them right now already make some form of disclosure around climate risk. 60% disclose their greenhouse gas emissions. A smaller percent disclose what's known as scope 3, but it's 60% for scope 1 and 2. Investors find it's material investors are finding that they're using that information to think about their purchases and sales of securities. So that's where we have a role to play as a non-environmental regulator, non-climate regulator. But that's our role in what we put out as a final rule earlier this year. It too is being challenged in court on authority. I look at it, I think it's fully within the law and how courts have interpreted the law, because it's consistent with 9 decades of disclosure regime around material information, what a reasonable investor is finding significant in their investment decisions. That's
Pretty straightforward. That is the intent, and I applaud you and your fellow commissioners on the process you went through in crafting this provision. So let me thank both of you for being here today. Thank you for your service. Thank you for your testimony. The hearing record will remain open until Thursday, June 20th, to allow senators to submit additional questions for the record, and the hearing is now adjourned.